actually do something not different, but we're going to introduce monthly. And what I mean by that is our research and our algorithms have always gone ahead and shared with you the best opportunities on a daily basis, right? So this stock is, hey, Michelle, welcome from UK. This stock is a 20 red and green, right? That's always been the vernacular we've used. And for those that have been with us for quite some time, and I guess I could go over it for those that are just joining us for the first time today. 20 refers to a level of exhaustion, right? So this particular stock at this interval, which has always been days, has experienced 20 straight days of closing lower than it closed 4 days prior. Now, of course, there's much more than just that, but if you could understand that concept, you kind of get the big picture, right? So 20 plus 4, because the first day had to have exhibited that from 4 days prior. So this particular stock on this interval, being daily, has experienced 24 straight intervals, being daily, where this has been the behavior, which means, and nothing's an exact science, but we've come up with these numbers, 20 being kind of like our golden moment, our golden opportunity, that when a stock gets to 20 and it's a reputable company, it's in the Fortune 500, a lot of volume, big market cap, like it's not going bankrupt is my point, and it's not able to be moved around by speculators too much. And what I mean by that is, say, for instance, you have a company that is only worth $100 million and it trades only like 1 million shares a day, and the stock is, I don't know, 7 cents. One person, theoretically, right, can come in and buy a whole bunch of it and move the stock up. Now, the ability of one person to move a stock is what we're unable to allow as a variable, right? So if the stock is going down, we want to know it's going down for bigger reasons than one person decided to sell, because that's a variable that we can't calculate. It's one person. How do I know if that guy or gal wakes up in a good mood or not that morning, right? So when it exhibits all these characteristics, big company, Fortune 500, worth a couple of billion at least, a lot of daily trading volume, we know that this is something that is moved by macro forces, not micro. And what I mean by that is oil's going down because during the Trump administration, I forgot actually the reason. I don't know, but I remember oil went negative, but it kept going down, 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 down. And eventually one would say, well, Anthony, oil's like an actual thing. It like goes into things. Therefore, at some point, well, not only does it go into things, but it costs money to produce, right? Like you don't just walk past like an oil river, right? Like you don't get your bucket and say, all right, I got some oil today. No, you have to get these big fancy machines that cost millions of dollars and drill and hire labor, and there's an input cost that goes into oil. Therefore, because oil is used in practically everything, and there's an input cost that goes into it, there is a real supply and demand, because the companies that produce oil are not going to pay. I'm sorry, someone decided it was a good idea to call me today. Sorry about that. Let's see. I think I'm back, right? Hopefully. All right, recording will not include audio. To include the audio. Now, audio's over there, right? Okay, so I think I'm back. All right. So for a company to go ahead and drill oil, they need to know that the price of oil is going to be higher than their input cost. Therefore, when the price of oil goes down enough, you could be sure that companies are going to stop drilling the oil. Therefore, there is a certain level of exhaustion, especially in oil, that, hey, this particular company has gone down 20 straight days in a row because oil's coming down. But that exhaustion can be measured in supply and demand, right? So as long as you understand that overall concept, you'll understand how the algorithm actually works. Let me just see something. The screen's being a little silly. Reclaim those. Okay. Sorry. I need to remember to shut off notifications of phone calls. For the most part, everyone knows not to call me, but every now and then, someone's silly, right? Anyway. So that algorithm is we've always been reporting it in a daily interval. And then what does red and green mean? Red measures a level of exhaustion that is kind of like a coiled spring. Like this particular company is going down with such velocity that the rate of change has picked up to such a degree over its 21-day exponential moving average. It's catching our attention. So the red bar goes up. The green goes ahead and denotes money flow. So is there still money going into this? So the company is going down. It's becoming exhausted. The selling is just like the selling is an outlier, right? Like there's been so much selling that it's really, really becoming a coiled spring. But the reason why we check out money flow is because if a company's going bankrupt, it's going to receive that much selling as well. But you'll see that there's no money coming into it. So when you see money coming into the company and the company going down with such velocity, you start looking for the opportunity. Where is this going to bounce? And how big is that bounce going to be? It's going to be dependent on how much of a coiled spring it's become, denoted by the red bar. So those are what we look for. Now, last week we introduced weeklies. Now, everything I just said is exactly the same, except each one of those bars, those intervals, is now over a week time frame. Therefore, when on the dailies, you would have 5 days, which it would equal now 1 week on the weekly. So the daily, when you see it get to a 20 red and green, for that to go ahead and resolve itself, it needs to start spiking up, right? Well, how long of a time frame is that spike up measured across? Well, the intervals are days. So if a 20 red and green decides to go ahead and spike up, it's likely going to spike up for 3 or 4 days. Now take that same approach with the weeklies. If a 20 red and green on a weekly decides to spike up, and I don't mean to use the word decide, like the stock is just like, hey, I'm having a good day today. It's when all of the metrics really, really get down to such a point that it springboards the opposite direction. It's a rebound. When the stock rebounds over a daily, it rebounds over a couple of days because the intervals are the same. Well, what does it do on a weekly? So on a weekly, if it's gone down 20 straight weeks and it's 20 red and green, and I don't mean 20 straight weeks, I mean each interval is lower than it was 4 weeks ago. So you could have a point where a stock goes like this, and it's just drifting down. Doesn't mean it has to be down every interval, but it has to be lower than it was 4 days ago or 4 intervals ago. So when that's a weekly, you can go ahead and get into that conceivably, right? And the time frame that you'll experience the rebound is going to be over a couple of intervals, which on a weekly equals a couple of weeks. So what's the difference, right? Like, why would somebody want to get into a daily when weekly sounds way better? It sounds like it could be going up for a couple of weeks. Well, daily allows you to make a quick buck, right? Like if you like active trading, you could get in here and likely get out in a couple of days and do it. And of course, you take on a higher level of risk because the options that you're going to purchase have a shorter duration. If you're expecting to get in and out in a couple of days, you might buy an option that only has 1 month of time, which makes sense. But if you do not get the move you're looking for, the time now really starts beating you up. And God forbid the stock's going the opposite direction. Now the time is becoming decreased. You have less time for that option to make sense. And you're further away from the stock meeting its strike price. So the dailies require a higher level of attention. Now, the reason we started, sorry, my head is like, I'm so tired right now. The reason why we are offering or started sharing the weeklies is because, well, I guess that really makes sense, because me personally, been so busy with our Rhino Street launch. Now, because everything we do is me sharing my research, me sharing what I'm doing, it only makes sense that a lot of what you're going to receive on your end has a direct is directly a consequence of the things that are going on in maybe my personal life. And by personal life, I mean business life, personal life, I don't know, what other life is there, right? So when I'm in here, maybe 24 hours a day doing Rhino Streets, I don't exactly have the opportunity to watch a stock on a daily basis. So I said, you know what, let me go ahead and introduce the weeklies, because the weekly allows me to not worry about the stock for an entire week. Think about it, on the dailies, 1 bar, 1 interval equals a day. On a weekly, 1 bar, 1 interval equals a week. Therefore, if I check it once a week, that equals once a day, depending on which one you're at. And that worked out really well. In fact, we did 3 positions last week. I believe we sold 1 because we wanted to just take, I was home Friday being daddy, so I was watching my son. And I was like, you know what? I'm like so energetic that I can outrun my own son. So why don't we trade options too? So I went ahead and sold 1 and made, I think, a quick 16% on shorting the market, which again, I shared with everyone, right? It's never like, oh my God, Anthony did that. He didn't tell us. This is probably the most transparent program that you've probably ever been a part of. And not just you, but anyone. That's what our aim is. So the other 2 positions we're holding, and we expect to hold them for maybe another week, 2 weeks. Let's see what happens. But because we got in and out quite quickly on that position that we sold profitable and then we shorted real quick profitably, we have money that's in the account that we're like, what are we going to buy? So we're going to take a look at the weeklies, but what I wanted to introduce even further is the monthlies. Now, the cool thing about monthlies is each interval equals a month, which means if you are at a 20 red and green, so to speak, well, if that resolves itself in a couple intervals, like we know with the dailies, like we know with the weeklies, you're holding a stock that presumably is going up for a couple of months in a row. Now, the monthlies go ahead and by the nature of their duration, they are really great in being able to detect secular changes. And what I mean by that is you have cyclical changes and secular. Cyclical changes is kind of like a micro thing, like, all right, the weather's going to be better, like cyclical, like summer. The weather's going to be good this summer, therefore let's buy cruise lines. That's very cyclical. That trade is only going to last you 2 or 3 months because then the winter comes, the cycle of the weather changes. Secular is like global warming. It's like, okay, the earth has experienced this for X amount of years. Now it's going to change and experience this for X amount of years. So for instance, the internet, the invention of the internet was a secular change. That changed things for a long time. Oil going from negative $37 and welcoming this president in and Russia invading Ukraine is a secular change. That changes the oil price for many, many months and maybe even years to come when you take a look at debt plus inflation plus global instability. So there is a particular secular change that we're looking for that we are seeing in the monthlies, and that's in China. So for, I believe, like a year and a half now, China has just been getting annihilated. And it's got me thinking, China's not like a do-to-do country. Like they're really, really smart. And when I took a look at what's the highest red and green for monthly, it's actually Alibaba, which is a 19 red and green, which got me very excited. 19 red and green, I would buy it on a daily, but a monthly, I could buy this and probably own it for the next year. Why wouldn't I do that? Especially since I don't have the time to trade things around. Could I buy Alibaba, buy a 6-month option and be quite happy? I think so. So we are going to do that today. So kind of a spoiler alert, right? But then it got me thinking. So most of the trades we do, we have a certain semblance of intelligence, right? Like we can make sense of, oh, this is going to do this and speculate. So we always have somewhat of a handle of the positions we buy and somewhat as being actually fairly generous, right? Sometimes we don't really know, but we allow the market to tell us. But when we can actually get a semblance and understand the position, it's all the better. Like Twitter, right? Like we understood Twitter. Like McDonald's, we understood McDonald's. There's positions that we just inherently understand. Alibaba is one of them. We do understand it on a secular trend. China is a communist country. China owns all the corporations. Now, let me rephrase that. The corporations in China are owned by the corporations, but the Chinese government can step in at any point and say, hey, listen, we're actually going to kill your whole board. We're going to take these people, put them in position. We're going to let them run the company. Hey, guys, when we put you in position, you see what we just did? We actually just killed them. Do you want that? No, right? Okay, cool. And that's not an exaggeration. Like, that's China. Now, it does feel like an East versus West kind of battle starting, right? Like, you have Russia that's against Europe, and then you have the whole West against Russia, but the people they're still able to sell the oil to is India and China. And then China, like, I think Russia's worth like $1 trillion. China's like 30 trillion or 25 trillion. So they're the behemoth over there. But the thing about China that makes them so important is that because of their cheap labor policies for X amount of years, the US companies have always outsourced labor to China. They've always outsourced supply chain to China because it was just cheaper. Now, that's all well and good until one day where China's like, we don't think we want to supply you anymore. And they would never just say that, because that's like, back in when I was a teenager, we called that those be fighting words, right? Like, you would never say that. But how would you say it? Oh, we're experiencing COVID, right? Like, we have to shut down for COVID. Now, you would say to yourself, well, yeah, it's COVID. Like, I get it. But do you? There's vaccines that exist. Now, when you measure the vaccines as an individual versus measuring it as a mass thing, they're different, right? Like, as an individual, you look at a vaccine and say, okay, the death rate is kind of like 1 or 2%. No one ever tells you about that, but it's around there, right? Well, I don't want to risk my own life having a 1% death rate when I kind of feel like I'm not really going to get COVID. And if I do, I see people living with it and they're fine. And the doctors know what to do at this point. The hospitals aren't overrun. I'll take my chances there. Okay, that makes a good analysis as an individual. As a country that has 1 billion people, well, if you don't want any of your population getting COVID, you would just mandate they all get the vaccine. And you wouldn't care if 1% died, because as it pertains to a country that has 1 billion people, 1% is what, like 1 million? No, 10 million? As every life is worth something, right? Like, that's not me talking about them personally. But as a communist country, if 10 million people die, you don't really care. Like, you just know. So you can solve COVID fairly easily, but they didn't. And COVID, for the most part, I think we all agree, started in China, right? Like, started in the Wuhan laboratory. And China, through the entire COVID cycle, has never had more than like 30 cases a day. And you think to yourself, 1 billion population, 30 cases, either they're immune to it, they already knew it was coming, they've been predisposed to it, like swine flu and all the other flus that they've had coming out of China, because I've never been to a China market, but they look disgusting, right? Like, they look like they take bats off the floor, put them on a stick, and like people eat them as they walk by. I'm not saying that's good or bad. I'm saying it doesn't look very sanitary. So they've kind of have much practice with flus and viruses and stuff. So you would think during the peak of COVID, a country that did so well with it, now all of a sudden COVID's peaked maybe a year or two ago, and now they're having a problem with it. Well, do we think China is an honest country, right? Like, are they going to tell us everything they're doing? I don't think that's the case. Now, if China saw this as an opportunity, hey guys, their supply chain is completely, like, really, really bad. And they have this president that can't actually put 2 words together. And they're having this inflation problem over there. And every one of them is coming to us like, please, 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 get the supply going. It kind of puts us in a position, like, this is the moment that we could say, hey, West, like, see you guys later. We could go ahead and take over, because instead of outsourcing our supply to you, we could keep it within house. And now we're the dominant country in the world. That makes sense to me. Like, China's been the dominant country for many different cycles. You've had the Ming dynasty, you've had dynasties before. The US is like, we've been around for 300 years. China's like, talk to me when you've been around for 10,000, right? So it's just different. Now, what makes me really, really consider this is that Apple was told by China that their supply chain's not going to help them, that they're backlogged or whatever they said. Apple's the largest company in the world, well, behind Saudi Aramco, which is an oil company, right? But like in terms of the US, most dominant countries, most dominant companies, Apple. And if China's unwilling to find a way to make it work for Apple, there's only one Apple. So when something like that happens, you start thinking to yourself, like, wait a second, is their COVID that bad that they're willing to go ahead and upset Apple? And they're willing to jeopardize Apple getting a supply chain somewhere else? They're Apple. Or are they making a shift and saying, all right, we can go ahead and become dominant while you guys figure this out? In fact, as we cut you off from supply chain, you're going to see the prices of everything go even higher because you no longer have the product. You need to go find it somewhere else, or we'll give it to you little by little, and then the market takes over. The market wants 1 million of product ABC, but they're only getting 100,000 of product ABC. Now, 100,000 is 10% of 1 million, which means that product now has to be 10 times more expensive to go ahead and equal an equilibrium between the 1 million the market wants and the 100,000 the market's getting. What happens to inflation at that point? Well, if inflation starts really, really ramping up even more because of supply chain disruptions, at what point does this country just have like a civil war? Like this country is not in a state where people have money. You have inflation going through the roof. You have jobs that, because the margins are getting squeezed through inflation, they're not exactly saying, okay, we're giving you $20, $25, $30. They're like, we can't do it because we're getting pinched over here. So you need to work doubly as hard for the pay that you have, or you know what, kick rocks. Go see if your unemployment is going to be inflation adjusted, right? So it starts dawning on me. All right, so how does this equal Alibaba? Well, Alibaba is the Amazon of China. Okay. Well, Amazon is a big market center of products. The big market center of product is sold by people or companies. That profit margins on these products are dependent on the profit margins the seller has. So for instance, if I'm a seller on Amazon and I'm selling shoes, well, now I got to raise the price of my shoes because I'm not getting as many shoes, or the price of the wholesaler shoe is going up and I have to retail it higher. Which means if I lived in China and these prices weren't upsetting me, I could theoretically sell my shoes on Alibaba by receiving the product through China cheaper than somebody receiving it through China that's sent to America. Therefore, Alibaba could be bigger and better over the next 10 years than Amazon. But for that to happen, China would have to now become the hub, the dominant place in the world, and it's in their power to do it. Now, we're not saying that they are doing it. We believe that they are, but how do you prove that, right? Like, that's one of those things you can only prove 10 years later. Oh, remember, we should have seen it coming. So I think that's the case. So I think China is worthy of buying. I think Alibaba is worthy of buying. That makes sense to me. I'm going to buy Alibaba today. We'll probably buy it, say like 6, 7, maybe 9 months out in options because we're buying the monthly. So that's my commentary for today. Let's go ahead and share a screen and see what's going on. All right. Where is my stocks? Okay. Let's move some stuff around. Okay. So our research for last week was weeklies, in which case we shared Simon Property Group, which is now at 21 red and green. So we own it. We love that. Ford is now a 9. No, it's not even it's not a number anymore because it's higher than where it was. Hold on, someone's chatting with me. Wow. Hey, Michelle, lovely. If I could impress or surprise Michelle, then I am doing a good job because she is has a high standard palate, even though we're not feeding anything, right? So as you can see, my brain is a little tired because that was a really, really not impressive comeback or compliment, or I'm just going to shut up now. Win is a 14. Well, See, now it's no longer red and green. This is what it looks like when it's resolving. So let's take a look at something. So when this was a 13 red and green, it got as low as 57. It resolved over 2 intervals. Look how high it got, 68. It went up 11 points in 2 intervals. Now those 2 intervals equals 2 weeks. Now granted, in this one, 2 weeks equals 10 days, right? So in 10 days, you found 57 to 68. On our dailies, we never get the opportunity to see something move, say 57 to 68 over a day or two. Now we do, but much less frequency than you would see it over a week because the week has a longer duration by definition. So we're going to get rid of Win because it no longer qualifies. We're going to get rid of Ford because it no longer qualifies. Now I'm going to leave Ford because I own it, right? I bought it last week. So Win doesn't qualify, but I also don't own it, so I don't care. Gap, 12 red and green, but 12 is 12. Now, of course, Alibaba, it's like people listen to it and buy it in front of me. It's up 8 points, 9%. So just in case you thought I might have already known that reaction I just gave was 100% genuine. Okay. So look at Alibaba at a 16 red and green, right? It was 75. Look at Alibaba at a 17 red and green. It was 82. Look at Alibaba at 18 red and green. It was 78. Look at Alibaba now, 101. Now what happened? From 16, it's taken 3 bars and it's gone up 30 or $25. From 17, it's taken 2 bars and it's gone up $20. From 18, it's taken 1 bar and it's gone up $20. So when you're working with monthlies, now let's say, all right, and in 2 or 3 more bars, I could see it over here, right? And 2 bars, I could see it here. That looks like it makes sense, right? Well, that's 120. It's now 100. 20%, is that good? I think so. Now, what really upsets me is that it's up $8. I'm not really prone to buying things up 9% in a day. Now look at China, 16 red and green. Now Alibaba is in China. So Alibaba was getting beaten up before the whole China index came down. Alibaba was the first one to get hit. So Alibaba, if we're looking at China, we want to go to Alibaba because it has 3 more months of like coiled spring. See, this is a coiled spring indicator. Now this isn't red any longer, it's a dark red, meaning that the coiled spring is uncoiling. We're able to go ahead and calculate that, which means this is going up. So you know what, instead of me being, you know what, I got a solution. Let's just buy half, right? We could buy half. And if it goes up further, we'll buy the other half, or goes down, right? Like we're gonna buy the other half anyway, but let's average it. So I'm down $3.50 today and my account's worth $4,650. Okay, Alibaba. And sometimes you'll catch yourself saying it in quite the fun way, like Alibaba. I just love saying that. I don't know if that's how they say it, but I love saying it that way. So let's take a look at options. Now we want to go out, so it's June. How about we go out to January? Because remember, Christmas season is in December. When is the season that most people buy stuff? Christmas. When would be the season that most people would buy stuff on Alibaba? Christmas. So I'm not sure that China celebrates Christmas. I don't think so. No, they definitely don't. But they celebrate making money, and people in this country celebrate Christmas. And where are they going to buy their products from? It's called drop shipping. You buy it from China at like $1, and then you sell it for $2. I think people are going to find out it's going to cost them more this Christmas, but that won't matter. So let's say January 2023. Okay. So let's say in January, now that's 6 bars. So that's 1, 2, 3, 4, 5, 6. Where do we think Alibaba is going to be by this time? All right, so let's play a game. Let your fingers do it. So it's coming, look how far it's coming down. Ooh, all right, it's turning up. Your fingers just kind of naturally go to 150. So let's take it down to 125, right? So let's say Alibaba 125 by January. Now these are quite expensive. So let's see. Buy to open, let's limit the price to $9. One quantity equals $900. That's a lot. So let's just buy one, right? Like we don't need to buy too much today. And the order currently has been executed or rejected. It can't be canceled, which means if we go into our orders and we press execute and we press executed, we see Alibaba $9. We got it, right? So we could go to our portfolio and say, do we have Alibaba? We do, $9. And of course we're down already because that's the story of our life. Now, Simon, you know what? So Simon Property Group was what, a 21 red and green, and we're down 42% on it? I got to tell you, that makes me want to buy more. We have 137 days for that to work out. So let's buy 5. How much is that going to be? Let's do a limit of 150, $700. Let's do it. Why not? See, same thing. Portfolio, let's go back there. Now we're down only 29%. It's like magic, right? We have $600 left. Ford. We have only, we'll leave Ford alone. We only have 102 days left on that. So we'll see what we decide to do with Alibaba, because the $600 left is less than probably what it's going to cost. So maybe we find money, maybe we leave it alone. We'll see what happens. All right. So that, well, actually, let's take a look at where the market is, right? Up to 95, NASDAQ's leading the way. The VIX is up as well, which is really not a good thing, because when people are becoming more volatile while the market's going up, it sounds like they're waiting for something to happen. Let's go take a look at the SPDR index, which we've been mailing about. It's the exchange traded fund to replicate the performance of the S&P 500. We call it SPDR because the ticker is SPY, SPY, DIR, right? Okay. So let's see what's going on here. Oh, go away from me. All right. So let's see. Let's clean it up like we always say. Oh, my back. Getting old. Do you know I'm turning 36 Saturday? I know what you're saying, Anthony, you don't look a day over 25, but I am. I'm turning 36 Saturday. And I find that when you wake up sore, like you get sore from sleeping, you're old. And I've unfortunately been experiencing that. All right, so it's stocks going up, volumes going down. That's our alligator mouth. We just made that up this second. Volatility's been going down. Okay, so the market's becoming complacent, but less people are buying the market and the market's going up. You make it look so easy. Michelle, you are fantastic. All right, so let's do one of these. I have a lot of things going off right now. Okay, so market's been going up, volatility's been going down, but volume's been going down, which means it's going to stall at some points because people are getting a little, the volume isn't corroborating it, right? So let's go ahead and pull it out a little further. So what's been going on in the last, let's look at 4-hour intervals now. So each one of these bars represent 4 hours. So we could kind of quote unquote go under the hood a little bit, see what's going on. All right. So as we take a look at what's been going on most recently, you could see that the market's been going sideways. And by sideways, I mean like, well, I guess like sideways, right? You see it in this channel. What's been going on with volume during this time? There's the channel, volume's been going down. What's been going on with volatility during this time? Volatility's been going down. Okay, so let's pull it back even a little further, right? Let's say we did 2 hours. Let's go under the hood even more. Okay, what do we see? Well, when we go under the hood a little more, we can see that the market was going up here, right? But then came down, and it's going down here. And now it's made this pop up to this resistance level, the top of the channel it's been trading in. So the presumption is it's likely going to hit its head here and come back down, or it's going to break out of this and shoot up higher, right? So this is what we call the moment of truth. At 418 on the spiders, we're going to learn whether the market's going to go up or whether the market's going to go down. But how can we predict that ahead of time? Well, I don't know. Let's find out. So what we can see about the volume is it was going up while the market was going down. That's bad. That means we're seeing people selling more than we see them buying, right? They have the propensity to sell more when it's going down versus the propensity to buy when it's going up. Not good. Also, what do we see with the volatility during that time frame? It's no longer going down. It's kind of going sideways, right? Okay, well, that's not good. So what's happening now? All right, market's gone up. Oh, volume still going down. And what's going on with volatility? Volatility is going up. So what does that mean? It means we are willing to say that we believe if the market gets to this line, it will bump its head and come down. Meaning, if you were looking to buy something, there's likely a better time to buy it in the near future. Or if you were looking at taking a short position on the market, you want to go ahead and profit with the market going down, it might be an opportune time to do that. So let's actually take a look at that, because our portfolio is 3 positions. They're all long. They all involve the market going up. So if we believe the market's going to go down, we can buy a position that will profit when the market's going down as a hedge, right? Our positions that profit when the market's going up, which is 3 of them, will lose money. But the position that profits when the market's going down will make money. So it'll offset, meaning we'll be able to keep the value of our portfolio even in a down market because we're able to predict the market's going to go down. So what would we do? So let's take a look at sectors, right? Do any of these sectors look weak to you? So we'll just scroll through them. This looks okay, right? Let's just find the one that looks like the worst, right? The one that I wouldn't wish on my best friend. This one looks like it already bumped its head, right? And it's already coming down. It's down on the day. What is this? Energy. Well, I did see a lot of reports that people are looking to take a short position on energy. So that might be a self-fulfilling prophecy. And what I mean by that is people say it, therefore they act on it, therefore it happens. This looks horrible. Healthcare. But if a market's going down, I don't really want to short healthcare. That's kind of where people run to. This one looks like it's breaking out. And not only, it didn't bump its head, it just kept going. So industrials look relatively strong. So I'm definitely not shorting them. They look very good. This looks not so great. So I got to tell you, oil actually looks the worst. And I know what you're thinking because I could hear you thinking it. Anthony, oil's going to like a bazillion. And that's what makes it the opportunity that everyone just loves it so much that when that sentiment changes, there's a lot of downside, right? So look at that. Look at oil. It's just been going up nonstop. Now let's put a trend line under it, see where it is. All right, connected. We're under it. So you know what? Let's take a short position on energy. And by let's, I'm talking about myself because I'm actually cuckoo for Cocoa Puffs. So and I'm a Gemini. So I'm not just one person. I'm multiple people. So when I say, Anthony, yes, Anthony, what are you doing, Anthony? Let's go ahead and do a thing on oil. Why are we doing it? Because we're going to do it. I'm actually talking to myself. So let's go ahead and go into July, right? And again, let's is me. And we want to buy puts. It's 89. Where can it go? If it breaks this, I don't know. Over here looks fine. 87. So 87. Let's do it. So let's trade that. Let's see if we can afford 2 of them. Buy to open, 2. 315 plus 325 is 640 divided by 2 is 320. Let's see if we could get this. Bingo. Was his name Obingo? All right. So we have this really, really amazing ability to have all of our positions that go up in an up market and our positions that go up in a down market all right at the same time, which actually means scientifically we are the worst ever in the history of the world. And obviously I'm being a bit facetious, but that's interesting. Like that's a lot of red. At what point would you say, why am I following this guy? Well, the answer is you shouldn't be following anyone. You should always think for yourself. And I hope that illustrates it because I am horrible. All right, so actually before we get to anything, I do want to go take a look at Don's because I adore Don. All right, so let's see what's going on here. Anything worthwhile? So Don, and I don't know if you're answering, I'm just referring to you. Remember we were talking about the Swiss franc. Now this is a good representation for everyone to see. 21 red and green, or 22 red and green, but it kept going down. But it was still red and green. So it got to a point, well, look, this is really a coiled spring. Look at that. Poof. Now in the foreign exchange market, going from 89 to 93 in a matter of a week makes you a trillionaire. Now, I remember saying to everyone, I need to learn currencies. I didn't. So obviously I'm not a trillionaire. But this was, and maybe Don, are you with us? Is this not like one of the moves of a generation? Like if you capture that move in Forex, you are kicking butt. If Don's with us, just share a little bit of commentary whether I'm right or wrong on that. Because I've never done currencies, right? All right, so let's see. Oof, this looks ugly. Japanese yen against the US dollar. Now we don't have the numbers here, but that's setting up to be quite ugly. Now there's a Swiss franc again as the actual currency, 30. So 99 all the ways up to 104. That is cuckoo for Cocoa Puffs. All right, anything. Same thing with silver, got down to 19, red and green, boom. So 19 to 20, so not a lot, right? But in silver, still not a lot. All right, that it went up though, so that's all that matters. Look at that move. So I'm taking a look at this. This is a 30-year bond. This is a 10-year bond. Obviously, we weren't able to capture it because it didn't get to here. But could we have captured it, right? Could we have looked a little further under the hood? Well, this is a 10-year. What about a 2-year bond? Whoa, you would have been able to capture it. Look at that. 17. Wait, what am I looking at? 98.09 to 99.27. Now, I know that doesn't sound like a lot. In the bond world, that's a lot. In one day, especially. Look at the 5-year. Boom. So we were able to identify some stuff, and I believe, Don, we did share the bond stuff with you. I want to take a look at a weekly on Don's stuff, see if we could offer anything good today. I want to offer something actionable, not just, hey, we were right? Sorry, Don, not looking like anything just yet. We will get back to it next week. And then crypto, I know people love some crypto. So we just don't like Bitcoin because we believe it has to wash out. But oh, my pleasure, Don, thank you. We believe it does have to wash out. And we believe the path of least resistance is once it really slices through this 30, we believe is going to probably go down to 15. And the reason we believe that is because the largest company that owns crypto, MicroStrategies, they get a margin call at 21,000. The fact that we know that means the fact everyone knows that, which means if crypto was in a position to get beaten up, people will beat it up to go ahead and make MicroStrategy have to sell all of theirs, which would destroy the market, but would offer one of the most amazing generational buying opportunities. So we don't know if we're going to be right about that. But we believe the fact that there's a chance we may be right about that, we're just going to wait. And if it doesn't happen, it doesn't happen. But if it does happen, that's a generational opportunity. So it doesn't look like anything's going on with crypto either. So let's go ahead and put this down. Let's stop the share. All right. It's always so funny how many people are on at the end of the call. Like it's literally 6 times more than we started. So that's super cool. Love everyone. I will see you all Wednesday. We're going to share a lot more with Rhino Street. We're going to have the updates to show you on the subdomain landers. A new app release is coming out today, so you will receive that. I'm waiting to send out the Rhino Street email until I have that. Oh, Abigail, which everyone loves, will, I believe she's sending over the 1.0 version of the cartoon that we commissioned her to make on behalf of Rhino Street. I believe we'll have up to 20 e-learning programs done. The reason I haven't gotten aggressive with nudging anyone to recommend other businesses is that the automated emails, I tested myself and they're sending not the wrong one. It is the wrong one, but if someone didn't know what the right one looked like, the wrong one would look just fine. But since I know which one the right one is, I want to wait till the right one's there. And that's simply just Salesforce correcting it. In fact, I've emailed them, and if I don't hear from them in like, I don't know, 15 minutes, I'll email them again. So that's that. Love everyone, and go Rhino, right? All right, bye guys.